First on CNBC interview. Of course, today marks the first day that PIMCO's total return ETF trades under a new ticker symbol, which I believe is BOND. Bill, congratulations on the quarter. You got some good props from the likes of the Journal and everything else, so congratulations.
Thank you, Carl. Like a golfer says, it's better to be above as opposed to below the grass, and we're enjoying it. Thank you.
Let's talk about the minutes first. Do you agree with the way they're being read, that somehow this makes any further injection of liquidity less likely?
I don't. I think it's sort of much ado about nothing, or maybe much ado about a little. I think we should think of the Fed sort of as a chess game with some of the pieces more important than others. And Bernanke obviously is the king, Yellen is the queen, and maybe Bill Dudley is the castle, and the others are basically knights. And so I think you have a story when some of these major pieces, when one of the three basically concedes and says checkmate. But we haven't seen that, and until that happens, I think this wordsmithing in terms of a couple or a few, I think is relatively unimportant.
Yeah, it's tough to read. Here's your tweet from this morning. Central banks are where bad bonds go to die. Without QE, the financial markets and then the economy will falter. You want to expand on that?
Sure, and let me expand and say, yes, central banks are where bad bonds go to die and good stocks are born, I suppose, much like a star. Bad bonds, what are those? I think in terms of the ECB, those would be peripheral bonds that they've been buying in the hundreds of billions. And in the United States, are they the treasuries? Well, to a certain extent, yes. The 10 years, the 30 years that basically no one would buy at these types of levels. And so we're operating, yes, in a subsidized market where a 10-year yield at 2.25 and a 30-year yield at 3.35, is a subsidized level. And who would buy them unless the Fed buys them? Not too many buyers, I don't think.
Mr. Gross, no longer presumably will your tombstone reads RIP. He didn't own treasuries, as you have suggested it might. You've obviously had a good quarter. The reason that you've had a good quarter is because you've bought into these mortgages. And you now hold, I believe, about 38%. And, of course, they have risen in anticipation that QE3 would involve the Fed buying mortgage-backed securities. Let's cut to the chase. Do you continue to buy there? Do you believe, therefore, that the threat of the Fed buying exists? And does it exist out past 2012 and into 2013?
Well, Simon, I think that's sort of the cherry on top of the sundae. I think what an agency mortgage does for a buyer, and the yields are 3 to 3.5%, and that's not great, but it's better than, basically treasuries. But what an agency mortgage does for a buyer is provide a higher yield, and dependent to some extent on interest rates not changing. If interest rates go down a lot or up a lot, then the mortgage changes its character and its average life. So is it a bet on QE3? Not necessarily. It's really a bet on the Fed basically staying where it is until 2014. And if it does, then a buyer picks up 100 to 150 basis points in yield.
But isn't the great reassurance that if they're engaged in QE3, no way can they actually raise general interest rates? That's a guarantee. That's cast iron.
Oh, I think that's true. That cherry on top of the sundae basically would reaffirm that the Fed's not tightening. Now, let's look to the point at the end of June in which perhaps, and I don't believe this is the case, but perhaps the Fed, won't reinitiate a twist or a QE3. Basically, when that's happened, Simon, when QE1 is ended, when QE2 is ended, basically the stock market has gone down by 1,500 points over the next month or two. And so is the Fed trapped in this conundrum of, providing liquidity, cheap liquidity, in order to pump up stock markets and risk markets? I think they are. It doesn't necessarily mean, and I won't argue with Rick Santelli, he's not on the line right now, but whether it's a good policy, but it's a necessary policy based upon where central banks have led us.
Bill, I want to go back to your ETF. The last time I spoke to you, I believe, was when this ETF launched, and I asked you if you were concerned about cannibalization, in other words, flows into this ETF instead of the actual total return fund. What's your sense of what has happened so far in terms of whether you're getting incremental buyers or you're getting buyers instead of the buyers of the total return fund?
Well, we don't sense any cannibalization, Melissa. We're up to 330 million in terms of the ETF. That's BOND. We continue to have 50 to 100 million dollars worth of inflows daily in terms of the total return fund. So we're you know, bringing in money on both sides. The interesting thing is in terms of the ETF is that it's done so well, you know, 2% better than an average indexed type of ETF in the bond market. And you know, the critics would argue that the fees in terms of 55 basis points are much higher than, you know, the fees in terms of an indexed ETF. But you know, over the first 5 weeks, we've more than earned 5 years worth of fees based upon the 200 basis point outperformance.
Right, and in fact, we're showing a full screen of some of the competitors which you have outperformed since your March 1st debut, Bill. What do you account for the outperformance there? Is it being more heavily exposed in MBS, for instance? What do you think puts you over the top?
It is that. It is mortgages. It is as well, you know, a function of the flows. It's true that the total return fund hasn't gone up by 200 basis points relative to the market, but to the extent that flows have been coming in to the ETF in terms of a more rapid rate, then that has made a difference. But both the total return and BOND are doing super in the first 3 to 4 months here.
Hey, Bill, when it comes to stocks, a very smart market observer this morning wrote that it's no longer about bears versus bulls, but more what they call fundamentalistas versus liquidistas. And I wonder if you think that's where the debate centers right now and what side you'd be on.
Well, if I got your question right, I think it is about liquidity. You know, central banks have poured in about $2 trillion worth of money. They've written $2 trillion worth of checks, and you can call them QEs, you can call them LTROs, but there's been a lot of check writing over the past 3 to 6 months, and that, you know, has come with the affirmation and with the hope that equity markets and risk markets would rise. And so I think it is dependent on QE continuation, on QE3 or whatever it's going to be called, twist or you know, some derivation in terms of twist. But a central bank has got to keep going if they expect equity markets to continue to lie at this level.
And would you put a number or a percentage around how much of the market's rise has pivoted around promises of liquidity versus promises of economic recovery?
Oh, I think a good 10 to 15%. I mean, we can see that as QE1 and QE2 ended, 1,500 points down, you know, within a month or two. You know, those are only 2 data points, but, you know, I think a good 5 to 10% of the market has come through check writing from the Fed, and the rest has come through economic recovery, which in and of itself has come, of course, through Fed and other central banks check writing.
So, Bill, let me be quite clear here and double back on what you said before. Are you suggesting that there is a Fed put under this stock market? In other words, because the wealth effect is so important now to America with where we are on the recovery, that they will move towards QE3 if the market falls? In other words, can I buy the stock market? Is it safe because of the Fed?
I think there is a Fed put, Simon. There's an ECB put. I mean, there was a question put to Draghi about 2 weeks ago. What was the first thing he thought of in the morning? And he said where the stock market was. And, you know, Bernanke hasn't been quoted in those terms, but I think that's a fundamental consideration for central bankers. And is it the proper consideration? Probably not. But at this point, you know, markets are dependent upon, or economies are dependent upon markets. And is there a put, a Bernanke put? Is there a Draghi put? I think there definitely is.
All right, Bill, thanks so much for your time. Good to talk to you as always.
You're welcome. Thank you.